Hi, I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group. In December of 2019, Congress passed the Secure Act, which will open up a new distribution option for parents that are either having children or will be adopting children in years 2020 going forward. And that new distribution option is called the Qualified Birth and Adoption Distribution. And the way it works is parents are now allowed to take some money out of their IRAs, 401ks, and other retirement accounts, and where normally you would have to pay ordinary income tax and a 10% early withdrawal penalty for being under the age of 59 and a half, now that 10% early withdrawal penalty is waived if you meet certain requirements. So today we're going to be going over what those new requirements are, how much you can take out of those retirement accounts, tax strategies to kind of nullify some of the tax hits when you take these distributions, and other features like are you allowed to repay those amounts at some time in the future to your IRA accounts. First, let's look at how these distributions work and what the limits are. So after a child is born, parents are allowed to distribute up to $5,000 out of their retirement accounts, and they avoid having to pay that 10% early withdrawal penalty. Now notice I said the word after. You cannot make these distributions prior to the child being born. It's after their date of birth. And more specifically, you have up until 12 months after the date of birth to distribute up to that $5,000 and avoid the penalty. But remember, even though you avoided that 10% early withdrawal penalty, you still have to pay ordinary income tax and any disbursements that happen for retirement accounts. So in that example with Jim and Sarah, they distribute that $5,000 out of their IRA. Yep, they completely avoided having to pay that 10% early withdrawal penalty, but let's say they live in New York and they make $100,000 per year. That would place them in the 22% federal tax bracket and about the 6.4% New York State tax bracket, which means when they go to file their taxes, they're going to owe about $1,100 in federal tax and a little over $300 in New York State tax on that $5,000 they took out. But there's some good news that once you have a child, there is something called a child tax credit that's under current tax law that says you get a $2,000 per child tax credit for any child under the age of 17. So even though that $5,000 distribution might have generated $1,100 in federal income tax to Jim and Sarah, that $2,000 child tax credit will more than offset their Fed tax liability. They'll still have the New York State tax liability, but that's arguably the smaller amount. But it gets even better because that $5,000 limit is not just a per child limit. It's a per parent, per child limit, meaning each parent will be allowed to distribute up to $5,000 out of the retirement accounts penalty free. So two parents means you actually have $10,000 to work with, not just $5,000. Now, if you decide to go this route of distributing larger dollar amounts, you have to be even more aware of the potential tax impact of taking those larger distributions in a single tax year. And there's an advanced tax strategy that says if you have 12 months after the date of birth to make the disbursements, it may make sense to split those distributions between two separate tax years to make the tax impact less burdensome. So here's an example. So let's say again, Jim and Sarah, their child is born May 2020, and they want to take out the full $10,000 between their two retirement accounts. Jim may want to distribute his $5,000 in 2020, and Sarah might want to wait until January 2021 to push her $5,000 into the next tax year, because if they do it all in 2020, that full $10,000 is going to be taxed in a single tax year, which means, remember, 22% tax bracket on $10,000, that's now $2,200 for a tax liability. Their child tax credit only covers $2,000 of it, meaning they're going to be out of pocket $200 come tax time. Plus they run the risk that because they put more taxable income on the table, that could potentially bump them up in a higher tax bracket depending on whether taxable income lands in that tax year. In addition to this $5,000 limit being per parent, parents also have the benefit of it is also per child, meaning each child you have, you get another $5,000 penalty-free distribution from your retirement account. So Jim and Sarah have their first child May 2020. They each distribute $5,000 out of their retirement accounts penalty-free. Then in November 2021, they have their second child. That resets, and they can both again go back to their retirement accounts and distribute $5,000 apiece, all penalty free. One of the questions we've received is, if you take the distribution out of your retirement account for this qualified birth or adoption distribution, do I have to track what I actually spent the money on in case I'm ever audited by the IRS? And the answer is no. They do not require you to track those expenses. The fact that you had a child or adopted a child after 2020 is the qualifying event, which opens up to you the option to take those distributions penalty free. As I mentioned at the beginning, these distributions can be made from either an IRA or an employer-sponsored retirement plan like a 401k or 403b plan. Now, it's important to note that going into 2020, you're safe taking these distributions from IRAs, but if you have an employer-sponsored plan, you may or may not be allowed to make these type of distributions. It really depends on your particular plan, because even though the Secure Act laid the path for it to be an option within these plans, an employer has to voluntarily adopt that as a distribution option within the plan. So for employers that want to add this as an option to their plan, they have to contact their third-party administrator and say, I want to amend the plan to allow these qualified birth and adoption distributions. Now, employers may also have to be patient with their third-party administrator because the law was just passed in December 2019. They're probably in the process now of creating new distribution forms, updating their record-keeping system, their tax reporting system to allow these new types of distributions. There is also a feature within these new rules that says parents will be allowed to repay these distributions back into the retirement accounts after they're taken at some future date. Now, we don't have a lot of clarity yet from the IRS as to how that's going to be allowed or when that's going to be allowed, but just know that this is going to be a possibility going forward, meaning in any given year, if there's a contribution limit for an IRA or 401k plan, you should be able to return that money to that retirement account over and above the contribution limit for that given tax year, but more to come. As I've mentioned a few times, this special distribution rule also applies to parents that are adopting children years 2020 going forward. The only other small special rule with that is the child being adopted has to be under the age of 18 to qualify for these special disbursements. The other thing that I just want a reminder about, the disbursements have to happen after the adoption is finalized. I know there's a lot of costs normally leading up to an adoption, but the monies cannot be dispersed from your retirement account until after the adoption is finalized in order to avoid the 10% penalty. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.